Welcome to this Bennett Explains finance video. This week, why long-term investors should not worry about negative interest rates. Leave the worrying to journalists, don't panic, and do not be tempted to change your investment strategy. So, first of all, what is this negative interest rate world we're now in? Well, it's kind of through the looking glass. It's Alice in Wonderland because normally the world we know features positive inflation, albeit low. Prices for goods and services tend to rise. We expect to earn more money from our employers next year as opposed to this year, and so on. Equally, you tend to expect to earn a positive interest rate on cash at the bank. That's the normal way of things. However, the new order, or what could become the new order, features a rather different world, where you've got zero inflation or even deflation, prices gradually falling over time. Implication in theory is you should be negotiating a pay cut at the end of the year, not a pay rise, and flat or even negative interest rates. The bizarre idea that you might put money on deposit and someone could charge you for putting it there. Well, that's kind of upside down, topsy-turvy. So what's going on? Well, the normal world, as I mentioned, is this. And I'm going to introduce three characters: you, a commercial bank where you might keep your money, and a central bank behind the scenes. And the relationship is fairly similar in both cases. You would normally put your money that you want to safe keep for a rainy day, for example, into a commercial bank. Behind the scenes, they keep what are called reserves with central banks. The Bank of England's a central bank, the Federal Reserve is a central bank, the Bank of Japan's a central bank, and so on. And the normal cycle of things is those banks can earn a small amount of interest, admittedly, on those reserves, and you hope to earn, admittedly, a small amount of interest on the money you've left with the bank. Everybody's kind of happy. Now, in a world of negative interest rates, you get a slightly weird thing happening. Money goes on deposit at a commercial bank. Those banks keep reserves with central banks. But then what happens is those central banks apply an interest charge on the money that's sitting with them. Wait a minute. So that is a bank putting money on deposit and being charged for leaving it there. Kind of a little bit crazy. So does that mean you might get charged for leaving your money with a commercial bank? Well, let's take a look at that in just a moment. Now, three questions emerge from this. How widespread is it? Why are central banks doing this at the moment? And what could the knock-on effect be over here? Well, let's take a look at those in order. First of all, it is getting more and more common for central banks, I stress central banks, to apply negative interest rates. If we were to look around the world, in February 2016, for example, using Bloomberg data, Sweden and Denmark apply a negative rate. That's a central bank to commercial banks on their reserves, as it's called. The Eurozone's jumped in recently. Switzerland's kind of leading the pack. And even the Bank of Japan's come in and applied a negative rate to the money left on reserve with it by other banks. So, roughly a quarter of the world's GDP, according to some estimates, is generated in countries where the central bank has applied negative rates. Why? What's the logic? Well, what they think will happen, this is the central bank's logic, what they think will happen is commercial banks will cut the rate that you and I and businesses can earn on deposits. That will get us to shift money away from deposit, get us spending, get us borrowing. So commercial banks will need to make more loans. Why? Because if they can't earn money on their central bank deposits, they've got to make up the money somewhere. And banks will invest in riskier assets. It won't be worth them leaving money on cash deposit. They'll move it out into the wider economy and get other bits of it going. Equally, savers won't want to save. Who'd want to leave their money on deposit and actually be charged for doing so? They'll therefore spend more cash and take advantage of all these cheap new loans. The economy will get moving. Everybody's happy, is sort of the theory. But there are plenty of critics around who say, hang on a minute. Okay, let's go back to that scenario whereby the central bank is charging a commercial bank to leave money on deposit. What will really happen over here? I mean, are retail banks going to start charging consumers to leave money with them? And who's going to go first? Because it's not really first mover advantage being the first person into the market to make those headlines. Do banks actually want to make riskier loans? It's all very well encouraging them to make riskier loans, move money into riskier assets, but bank balance sheets have been hammered hard enough after the credit crisis. Most of them are trying to get their act back together. Are they really going to be forced into this by central banks? And do consumers actually want more credit? And ironically, consumers might end up doing the exact opposite of what central banks think they'll do in this scenario. So explain what I mean by that in just a moment. Here are the short-term risks then. What if negative interest rates, which is this weird world we're not used to, cause panic, cash hoarding? Because people think, well, actually, what I'm going to do is sit on cash under the mattress, or maybe even something like gold, for example, because I know that the worst that can happen is I just don't earn anything on that money, not that I get charged for leaving it at a bank. So ironically, consumers might not spend more, they might hoard more instead, and you might even get a sort of spending strike. Because people think, well, why is this happening? Is it because prices for goods and services are falling? So I'll just wait a year to buy that new computer because it'll be cheaper in a year, and negative interest rates are indicative of that trend. So this could all kind of backfire in terms of what central banks might think is going to happen next. Now, the question then is, well, I'm a long-term investor. I'm not a short-term panicker or hoarder. What do I do with all this information? Do I worry about the headlines? No. Remember, as a long-term investor, it's the long-term average real rate, post-inflation rate of return that you earn on your money and how it compares to other places you could leave your money that matters. So as an equity investor, headlines about negative rates should be taken with a pinch of salt. Look back. The past is no guide to the future, but over the last 50 years, equities have turned in, and this is the important point, it's not the absolute number, but they've turned in a consistently higher, significantly higher real return annually than either government IOUs in the UK or cash. Now, no one's promising that will continue in the future, but the point is, how do negative interest rates impact that picture? And the answer is they don't really, other than realising that with interest rates and inflation close to or at below zero, nominal rates and real rates have to come down and move closer together. What do I mean by that? People say to me, where can I get 8% right now? We all struggle to get 8% unless you take a lot of risk. But the point is, in the days where you could get 8% on equities, inflation was probably 3, so your real return was 5. But hang on a minute, if you can get 4 to 5% nominal and inflation is 0 or even negative, there's your 5, if you know what I'm saying. So people have just got to adjust their expectations down to the kind of new normal. In that sense, negative rates and negative inflation matter, but in the broader picture sense, they absolutely do not. Now, conclusion therefore, yes, you're going to see a million headlines speculating on why central banks are doing this, what it means for savers, what could happen next, and there could indeed be some kind of short-term counterintuitive activity, panic with savers and so on. That's just for central banks to ponder, if you like. But for long-term investors, the underlying picture hasn't fundamentally changed because of those headlines. And an old saw springs to mind. Some people say that increasingly, as I do these videos, I look more and more like Yoda, so there he is. I would say, think about changing what you can control, managing what you don't, and know the difference. You can't change the short-term experiments being conducted by central banks, but you can manage the way you react to all this noise around negative interest rates. And that's the important message to take away from this video. If you'd like to know more, because I've covered a lot of ground there and quite some jargon, do feel free to email me, editor@killick.com.